Welcome to the deep dive. Today, we are really tearing into the strategy of a global giant, PepsiCo. We've got their prepared management remarks from Q3 2025, and our mission isn't just, the headline numbers.
Right.
We want to uncover the huge structural changes happening. We're talking major cost cutting and this intense focus on functional products. It feels like a real transformation.
It absolutely is. And what's interesting is they're starting from a place of, decent momentum. Q3 showed a nearly 3% reported net revenue growth.
Okay, 3% better than last quarter, you said.
Yeah, it accelerated a bit. But, and this is the big but, the overall guidance for fiscal 25 is still pretty cautious.
How cautious?
Low single-digit organic revenue growth and core constant currency EPS, earnings per share, they expect that to be basically flat compared to last year.
Flat EPS. Wait, if revenue is accelerating, even a little, why are earnings flat? That sounds like something's eating their profits.
Bingo. That's the headwind. Costs. Specifically, supply chain costs are hitting them hard.
Oh.
Think about this. Higher costs for global inputs, ingredients, tariffs, all that stuff took a 3 percentage point bite out of their core EPS in Q3 alone.
3 points. Wow. Okay, so that explains the urgency. They have to cut costs just to stand still on profit.
Exactly. It basically dictates their whole strategy right now. Mitigate those costs aggressively.
Okay, that definitely sets the stage. And before we get into the specific business segments, they also rejig their whole organization, right, to maybe get a better handle on things.
Yeah, they did. They streamlined it. Basically, think North America and international.
Okay.
So in North America, they merged Frito-Lay and Quaker. That's now PepsiCo Foods North America, or PFNA.
Got it. Foods together.
And then there's PepsiCo Beverages North America, PBNA. Pretty straightforward.
And international.
They split that up a bit more. There's a separate international beverages franchise business. And then convenient foods are broken down by region. Latin America, EMEA, Asia-Pacific foods.
So clearer lines of responsibility, maybe, more regional focus.
That seems to be the idea. Tailor strategies faster, respond quicker to local markets.
Makes sense. Let's dive into PBNA then, North American Beverages. This seems to be where that whole functional health pivot is really hitting hard.
It is. They reported 2% organic revenue growth there.
Which, again, sounds okay, but didn't you say there was something dragging that number down?
Yes, exactly. Their organic volume actually had about a 3 percentage point headwind.
Why?
It was a strategic choice. They decided to transition away from their low-margin case pack water business. They handed it off to a third party.
Ah, so they deliberately shed volume because it wasn't profitable enough.
Precisely. Less complexity, less low-value volume. It lets them focus capital on, higher margin stuff.
And that focus is fascinating. It seems like a two-pronged attack. Juice the core brands, but also bet big on these functional drinks. How's regular old Pepsi doing?
Trademark Pepsi actually saw volume and net revenue growth. But the real star is Pepsi. Zero sugar.
Zero sugar again.
Double-digit net revenue growth there. It shows people are responding to the marketing, the food deserves Pepsi stuff, but also just generally shifting away from full sugar.
Makes sense.
And they're getting traction with flavors, too, like wild cherry and cream varieties, gaining share.
And Mountain Dew. Seems like that brand runs purely on new flavors.
It kind of does. The flavor innovation engine is crucial there. Market share trends improved, pushed by things like Summer Freeze, Honey DDW, Dragon Fruit.
Right.
But the monster hit is Baja Blast.
Oh, yeah, they made that permanent, didn't they?
They did. And now it's on track to blow past $1 billion in estimated retail sales in 2025.
$1 billion. For one flavor.
Yep. Turning a limited time thing into $1 billion permanent fixture in, a year. That's proof their innovation process is working, at least on the flavor side.
Okay, so that momentum helps them fund the bigger bets, the health-focused stuff. Tell me about modern sodas.
Right, so look at Poppi. That's their acquisition in the sort of prebiotic modern soda space.
How's that doing?
Really well. $525 million in estimated retail sales year to date. That's up over 50% compared to last year.
50% growth. For a newish brand, that's huge.
Yeah.
Shows people will pay for those added benefits, huh?
Exactly. It's not just taste anymore, it's function. Same story with Propel, their functional hydration brand.
Let me guess. Big numbers.
Also on pace to cross $1 billion in estimated annual retail sales this year. They've more than doubled Propel sales since just 2019.
Wow. Okay, billion-dollar brands popping up. What about energy drinks? That category is so crowded.
Yeah, and they made a really interesting strategic shift there. Instead of just pushing their own brand, Rockstar.
Which they owned, right?
They did. They transferred ownership of Rockstar to Celsius Holdings.
To Celsius, a competitor.
Well, yes, but here's the swap. PepsiCo now leads the U.S. distribution for all three Celsius-owned energy brands. That's Celsius itself, Rockstar Now, and Alani Nu.
Ah, I see. So they leverage their distribution muscle across multiple fast-growing brands instead of just fighting for one?
Exactly. Consolidate influence, maximize the efficiency of their network. It's less about owning the brand, more about controlling the shelf space through distribution. Smart move.
Okay, so all this innovation, the goal for PBNA is what? Mid-teens operating margin.
That's the target, mid-teens core operating margin.
But to get there and fund all these new drinks and acquisitions, they need cash. Which brings us back to the cuts. What's the innovation pipeline look like, and how deep are these cuts to pay for it?
The pipeline is loaded with benefit stacking, things consumers want. We're seeing Pepsi prebiotic, Gatorade lower sugar, but with no artificial ingredients.
Interesting.
Even tapping into trends like dirty Mountain Dew cream soda.
Ah.
But beyond soda, it's heavily functional. Muscle milk reformulation, Starbucks coffee with protein, Pure Leaf mental focus tea, Propel protein water.
Protein everywhere.
Yeah.
So a massive product overhaul. But the cost side,
Right.
what did PBNA have to do structurally?
This is where it gets pretty dramatic. They're working on productivity, sure, but the big structural move. PBNA has cut more than 35% of its SKU count since 2022.
Hold on. 35%. A third of their products gone. Isn't that incredibly risky? What about distributors, customers who liked those niche things?
Oh, it's absolutely a gamble, a huge one. Cutting that many products that fast, it's designed to just ruthlessly eliminate complexity. Less inventory, fewer slow movers tying up cash.
But the risk of alienating people.
It's there. But the calculation you see is that the cost savings are massive. They need those savings to fight that 3-point cost headwind we talked about. They're basically cleaning house aggressively to fund this functional future.
That is stark. Radical cuts, funding radical innovation. Okay, let's pivot to the food side. PFNA, PepsiCo Foods North America. Sounds like performance needs a boost there.
Yeah, they're prioritizing improvement. They had some tough comparisons to last year, plus the whole Quaker recall issue from 2023 is still echoing a bit. But margin trends did improve from Q2.
What's the big story on the food side? More health focus.
Definitely. The buzzword is permissible snacking. Trying to give consumers that indulgence, but maybe with less guilt. And it's already a $2 billion plus portfolio for them.
Permissible snacking, like what?
Sun Chips is the poster child. Double-digit net revenue growth. It's actually the #1 permissible salty snack brand now, based on retail sales. Sun Chips alone should hit over $700 million in net revenue this year.
Okay, so permissible means better ingredients in familiar formats.
Pretty much. They're overhauling the core brands. Lay's and Tostitos are getting a global refresh. The goal is removing artificial flavors and colors from artificial sources by year-end.
Big changes for iconic brands.
Huge. And they're rolling out Doritos and Cheetos, NKD naked versions, no artificial colors or flavors, plus expanding things like avocado oil, olive oil, and Miss Vicky's, and baked Lay's. It's a fundamental shift.
They're also doing interesting things outside the grocery store, right? Away from home.
Yeah, that's a key growth area. Focused on experience, the walking taco platform, chips in a bag, add toppings.
Yeah, street food style.
That's delivering strong double-digit growth, especially in places like concession stands. And they're smart with partnerships, too. Think Subway Doritos Footlong Nacho, Taco Bell Doritos, Locos Cool Ranch. Keeps the brands visible.
Okay, but again, the funding, the blueprint for PFNA. If PBNA cut 35% of products, what's Frito-Lay doing? This feels like where the really tough cuts might be.
You're right. The cuts here are very focused on labor and assets. Get this, the Frito-Lay U.S. business already reduced its full-time headcount by approximately 7% just year-to-date.
7% of Frito-Lay's workforce.
Wow.
And you said more planned.
Yep, more planned. They are funding innovation by closing 2 plants entirely, shutting down several manufacturing lines elsewhere, improving route efficiency.
Closing plants, cutting 7% of staff. That's not just trimming fat. That's structural change. What does that signal about future staffing? Automation.
Absolutely. It signals a huge bet on automation and efficiency to permanently reduce labor needs. These aren't temporary freezes, they're structural cuts. And just like the beverage side, they're simplifying production too. PFNA plans to cut nearly 15% of its SKUs in Q4.
15% more SKUs gone. So both North American divisions are doing the same thing. Slash complexity, slash labor, slash assets.
It's a coordinated playbook. Cut the old, fund the new.
Okay, let's go global. The international business. You call this their stabilizer.
Yeah, it's the engine of resilience, really. It's huge. 40% of their 2024 net revenue came from outside North America, and it delivered 4% organic revenue growth in Q3.
That sounds consistent.
It is, incredibly so. This was the 18th consecutive quarter where international delivered at least mid-single-digit organic growth, quarter after quarter.
18 quarters. That's impressive stability. Where are the international highlights?
Beverages grew 6% organically. And interestingly, in the UK, the non-sugar Pepsi products, they've actually taken volume share leadership. So that zero sugar trend isn't just US-based.
Good point. What else?
SodaStream had high single-digit net revenue growth year to date. Convenient foods grew about 2.5%, with really strong showings in places like India, Egypt, Mexico, high-growth markets.
How do they keep that consistency going across so many different markets? It can't be easy.
It's all about localization, tailored strategy. They have a three-part approach.
Okay, what are they?
First, product relevance. That means tweaking flavors for local tastes, customizing marketing for local holidays or sports events, leveraging big partnerships like FIFA and F1.
Makes sense. Number 2.
Portfolio expansion, pushing those permissible snacks, the baked and air-fried stuff, functional benefits like protein into developed markets, but also accelerating their Sting Energy brand in developing markets where it's really popular.
Sting. Okay. And the third part?
Pricing and distribution. Constantly refining what they call price pack architecture, making sure they have the right sizes, the right opening price points, especially in developing economies where affordability is key.
So, local relevance, expanding the right products, and smart pricing. Okay, pulling it all together now. This whole deep dive shows these two massive things happening at once. Accelerate growth with all this functional innovation and implement really deep structural cost cuts. What are the big overarching changes enabling this?
It boils down to modernization and technology. They're standardizing processes using what they call global capability centers. They're heavily expanding automation in plants, warehouses.
Automation again.
Big time. But the really interesting tech piece they highlighted was accelerating AI deployment. Specifically, they mentioned unlocking the full potential of agentic AI across the whole value chain.
Agentic AI. That sounds advanced. What does that actually mean for a company making chips and soda?
Think of it like AI that doesn't just analyze, it acts. It's not just a report saying, hey, this SKU isn't selling well. It's an AI system that might automatically reroute delivery trucks based on live traffic data or adjust a factory's production schedule if an ingredient shipment gets delayed. It's like having autonomous virtual managers making constant efficiency tweaks without needing a human middleman for every decision.
Okay, so it makes the system faster, more responsive, and potentially allows them to operate with fewer people overseeing things. Helps make those labor cuts stick.
That seems to be the goal. Continuous optimization enabled by AI, which is critical if you're making permanent structural reductions in headcount and assets.
That connects the dots. The cuts pay for innovation, and the tech helps sustain the leaner operation. So after all that, what's the final word on guidance for the year? Did anything change?
They mostly held firm. Confirmed the full-year outlook, low single-digit organic revenue growth, core constant currency EPS about flat with last year.
So no big surprises there.
The only slight tweak was actually a tiny positive. They now expect less of a negative hit from foreign exchange rates. Before, they thought it would be a minus 1.5 percentage point impact. Now they're saying minus 0.5 points. So a little less currency headwind.
Okay. So to wrap this up for you, the listener, the key thing to grasp is this intense duality at PepsiCo right now. They are aggressively shedding things, closing plants, Frito-Lay cutting 7% of staff already, PBNA ditching over a third of its products.
Radical cuts.
Right. And it's all aimed squarely at funding this massive pivot into high-margin functional stuff, prebiotics, protein, zero sugar, everything.
And that whole strategy, improving those core operating margins, it completely hinges on managing this extreme tension.
Tension's a good word for it.
They're trying to do two huge, complicated things at once. Transform every major brand, Lay's, Tostitos, Pepsi, with healthier, often more expensive ingredients. That's complex. And at the same time, they're doing this large-scale structural takedown of labor, assets, complexity. So the provocative thought maybe is this. Can the cost cutting, which inevitably causes disruption and maybe instability, can it actually sustain the incredibly fast and complex innovation they need to hit their growth targets?
Can the savings keep pace with the spending and the disruption?
Exactly. The speed and the sheer scale of doing both at once. That's the tightrope they're walking. Their success really depends on pulling off that balancing act.
It really is the ultimate high-wire act in CPG right now. Thanks for helping us break down this huge structural shift.
Glad to. It's fascinating to watch.
And for you listening, it's worth thinking about how this blueprint, radical cost cuts meeting radical portfolio change, might be starting to play out in other big consumer goods companies, too.